Welcome back to Market on Close. We got 6 minutes till the bell, and of course we're watching shares of Coinbase after the direct listing of the crypto exchange debuts in public markets. What does it mean, and how does it fit into the macro context? We got Zed Francis, CIO and co-founder at Convexitas, to talk with us about all kinds of macro stuff. Zed, this is the historically most speculative asset class we've ever seen, crypto, and the exchange, which all that wild trading happens, is now in our public markets. Does this symbolize that we are embracing froth to an untenable degree?
No, I don't think it's untenable yet, but it also means you don't know when it's going to stop. I think the one thing that's easy to say right now is a year from now, we're least likely seat is going to be exactly where we are. We're either going to be up a lot from here or down a lot from here.
All right, so this is what the straddle market, just buy far out of the money puts and calls, and one of them will offset the cost?
Well, I think if you're looking at your portfolio allocation, you basically should run away from anything that looks like yield or smells like yield, because ultimately those assets are probably taking about the same amount of risk on the way down as something like an equity or VC fund or your Coinbase, but they have very, very limited upside. So first off, don't hold those things. And then you want to own things that have extreme potential upside, but then also other assets that are possibly negatively correlated that are going to benefit a lot if the market were to go down. So avoid things that can't appreciate significantly because they probably have about the same amount of downside risk as everything else, and then own things that can either go up a lot or actually make money if the market goes down. So
let's talk about the yield part first. I mean, we're talking bonds there. They don't really do much, or what else does that include?
Bonds, credit, frankly, probably real estate, things that look like I want to produce a lot of free cash flow, but my ultimate upside is somewhat fixed. That's what you want to avoid in this type of market.
Is that based on a view of rising rates?
I think that's a piece in it, but ultimately, if your bull case is kind of twofold in my view. One is policy. So you have fiscal that's creating artificial demand, right? All the surveys of stimulus checks going out. If you block it into like 3 buckets, are you going to buy things? Are you going to pay down debt? Or are you going to invest/save? Every survey says more and more is going into that invest/save bucket and less and less into the buy things bucket as time has gone on. So you have faulty demand that's being created from fiscal, and at the same time you have a reduction of supply. That's what monetary policy is they're trying to reduce the supply of total assets in the marketplace and force people up the risk curve. So policy is one side of things that is producing artificial demand, reducing supply, pushing asset prices higher, and frankly, it doesn't seem like either fiscal or monetary is going to be reduced, in fact, probably even accelerated going forward. And then the other piece that I think is creating a significant amount of upward pressure in assets right now is leverage. I'm sure you guys at TD have talked about a lot. Customers are using more leverage than they ever have before. That's the same across all custodians, across the street, across institutional investors, retail investors. And why does this help markets appreciate? And in a really somewhat simple construct, if you have $100 of capital and you're targeting a 1.5 leverage ratio, that $100 of capital is buying $150 of exposure. Now, say the market doubles. Okay, your 150 exposure now is 300, it doubled. And what's your capital base? Well, you had the $100 you started with and your exposure doubled. So now you got $250. You got $250 of capital, $300 of exposure, but your target was 1.5 times leverage. So to get the 1.5 times leverage on that $250, that equals $375 of exposure. The market went up 100%, and you have to now buy $75 more of exposure to get your leverage ratio back to your target.
So feeds on itself.
So this is why when there's a lot of leverage in the system and people are targeting leverage exposure, if the market goes up, it actually creates more and more to buy. And if the market goes down, obviously the opposite.
So this is where the kind of big move over the next year you see happening. You and I had a similar conversation pre-corona, and it was really before it was obvious how bad the viral impact was going to be on the economy due to shutdowns. Something that I've carried through from my understanding of what happened then, because your warning was that whatever happened next in markets was going to be extreme. When it became clear that we had a catalyst for the downside, then it went negative, obviously. So right now. Is there any potential that you see for something that could derail the market? Because it seems right now we've got tons of volatility and blowups happening within the market, but the index keeps grinding it out because when one group is down, the other's up.
Yeah, so there's a smaller warning sign I'd say I see out there, and then a larger one. The smaller one is the concept of monetary policy constraining supply in the marketplace that's forcing people up the risk curve and inflating asset prices. We're now going to have a treasury starting to issue a significant amount more of supply of debt that's actually going to surpass the amount that the Fed is currently buying at its target rate. So that I would say that supply function that monetary policy has been restricting is about to flip. We're going to start generating more supply.
Treasury auctions.
Taking out. So that's the smaller one, which is less of a catalyst, but is starting to set the stage where the Fed policy as it currently sits is actually going to be less effective in pushing assets higher just because we're creating more supply. That said, I don't want to be surprised if the Fed actually increases their amount of their purchases. The larger potential issue is the concept of a neutral rate. The neutral rate is essentially the level that the monetary supply or interest rates are not either supporting asset prices nor trying to I would say distract the fair value of asset prices, and that level is about 2.25%. So even as we're sitting right now, rates are obviously up significantly from where they were 6-9 months ago, but they're still actually supporting growth. They're still below that 2.25%. As we start pushing through that neutral rate, rates actually start restricting growth in the economy and in asset prices because it becomes actually unattractive to use that leverage. The cost of leverage starts actually costing more than the expected growth produced from those assets. So that's the kind of inflection point that I'm paying attention to. If we start pushing into the low twos to the mid twos in interest rates, and I'm using just tens, you can obviously look all the way across the curve, but using tens as just an example in this case, that's when I see issues and deleveraging kind of taking place. That's going to look quite similar to what happened September, October 2018.
Right, more rates-driven story.
At that point, even Powell reinforced in his December statement in 2018 that they were actually trying to slow down the economy. I don't think he's going to say that this time, but that's where that concept of neutral rate actually starts, constraining asset price growth. Okay,
so ultimately comes down to pressure from the economy that finds its way through yields, basically, and through the potential for kind of rates is that forced to cause some disruptions. And in the meantime, own the wings. So don't bet on a quiet market. Even though volume has been slow and things have been a little bit sleepy with all this internal rotation, Zed Francis says that we're getting some big moves in one direction or another.
We're still up 10% on the year, Oliver. It's a pretty substantial move in a little over 3 months.
All right. Appreciate it, Zed. Good to catch up. Zed Francis, CIO and co-founder at Convexitas.